Welcome students, welcome to lecture number 39 where we will be continuing with module number 6 under subject financial management. So module number 6, as we know, we had already seen capital structure and dividend decisions theory under lecture number 37. We saw leverages in a previous lecture, that is lecture number 38. So today we have just left with EBIT and EPS analysis. So let us first understand what is this type of analysis and then see problems on that. So let us first understand the meaning of EBIT and EPS analysis. It is an important tool for analyzing the capital structure of a firm, which includes debt and equity mix in different proportions. So students, as we know, the capital structure of a firm can comprise of maybe equity, maybe preference shares, maybe debentures, term loans. So every capital structure of a firm has a combination or a mix of equity as well as debt. Okay, and this EBIT and EPS analysis will help us, okay, in knowing what is going to be the correct mix, optimal mix, which is going to be beneficial for the company, which is going to increase the wealth of the company, value of the company. So this is a tool which will help us in analyzing the capital structure. This helps in understanding the impact of financial leverage under different financial plans. See students, what EBIT and EPS analysis does is it sees the various combinations. Like in some case, it may consider only equity and debt. In some case, only equity. In some case, only preference and debentures. So out of the different plans, these are the different financial plans that I've told you. So out of the combination of different financial plan, what will be the impact in each of the plan, financial leverage impact in each of the plan. This is done under EBIT and EPS analysis. So for example, two firms with the same capital but different structure. Now same capital, suppose both the firm requires a capital of suppose 20 lakh rupees. For example, both, there is a firm A, there is a firm B, and both require the same capital of 20 lakh rupees, but firm A is raising the 20 lakhs only through equity, and firm B is raising that 20 lakhs by issuing equity of 10 lakhs and debentures of 10 lakhs. So what happened? There is two firms, they require the same capital, but their structure is different. Structure, because in firm A there will be only equity, in firm B there will be debt and equity, so the structure is different, right? And this EBIT analysis will help us to know that how the change in the EBIT, earnings before interest and tax, how it will impact the firms even though if they are raising the same amount of capital. So for example, two firms with the same capital but different structure will be affected differently by the change in EBIT. So students, it is not the amount of capital which will impact the firm. It is majorly the capital structure through which they are raising the finance that will impact the firm if there is any change in EBIT. So this analysis helps in selecting an appropriate financial plan by finding the highest earnings per share. So out of the different combinations or out of the different mix or different financial plans, the company will select that particular plan which is going to give the highest earnings per share. Now this is earnings per share available to the equity shareholders, because at the end equity shareholders are the owners of the company. So if their earnings is more, obviously they will go for that particular financial plan. So I'll tell you what exactly happens in EBIT and EPS analysis. They will set before them different financial plans. When I say different financial plans, means different combinations and different structure for raising the funds. Okay, and out of these combinations they will select that particular structure where the EPS is going to be high, that is earnings per share. So for us it is very important to know that how we come or reach up to this EPS. How do we calculate this EPS? So let us see how do we calculate earnings per share. So EBIT, that is earnings before interest and tax. See students, this we have already seen in leverages also, but Once again, I will repeat, earnings before interest and tax. When I talk about interest, it is financial cost. It is interest that you're paying to the debenture holders, interest that you're paying to the term loans or to the banks, what you're taking. So from EBIT minus I, after minusing I, you will be left with EBT, then minus T, then you will be left with earnings after tax. See here, EBIT less interest, you're left with EBT. Then less this tax, you're left with EAT, earnings after tax, less preference dividend. Because equity shareholders get the share in the profit only after debenture holders are paid, only after preference shareholders are paid, they get at the last. Equity shareholders always get the remaining earnings. So first, from earnings after tax, you have to pay to the preference shareholders a preference dividend. Whatever is remaining, that belongs to the equity shareholders. So earnings available to equity shareholders is A. How do we calculate earnings per share? So if this is the total earnings, you're going to divide this total earnings with number of equity shares, which I named it as B. So earnings per share is nothing but A divided by B. So again, I repeat, you take EBIT, less interest, less tax, you get EAT. From this, you have to less preference dividend, you get earnings available to equity shareholders. When you get the total earnings, you have to divide it with the number of equity shares, then you get earnings per share. Now, this particular format you have to do for different financial mix or for different financial plans or for different capital structures. Wherever this earnings per share is the highest, under whichever capital structure chosen by the company it is the highest, then you have to select that particular capital structure for raising the finance. Now let us see the problems on EBIT and EPS analysis. Students, is this particular Word document visible to everyone?
Yes, ma'am.
Okay.
Yes, ma'am.
So let us start with the first sum. This is a previous year's question paper 2017 sum. Okay. ABC company is currently on ordinary share capital of rupees 25 lakhs. When I say ordinary share capital, the other name for ordinary share capital is the equity share capital. Usually, equity share capital is also known as ordinary share capital of rupees 25 lakhs, which is consisting of 25,000 shares of 100 each. The management is planning to raise another 20 lakhs to finance for an expansion program. See, students, already it has issued equity shares of 25 lakhs. Now the management is planning to raise another 20 lakhs. So it requires another finance of 20 lakh rupees. Now, what all options can it, raise this finance of 20 lakhs? So the options are entirely through ordinary shares, means complete 20 lakhs, raise it through the issuing equity shares. Next, option B, 10 lakhs you raise through the ordinary shares and remaining 10 lakhs you raise through debentures of 8% per annum. The third option is rupees 5 lakh through equity shares and rupees 15 lakhs through debentures at the rate of 9% per annum. Fourth option is 10 lakhs through ordinary shares and 10 lakhs through preference share with 5% dividend. The company's expected EBIT will be rupees 8 lakh rupees. Assuming tax rate is 10%, determine EPS and comment which alternative is best and why. So students, when such problem is given to you all, what you have to do is use the EBIT and EPS analysis. In that, what you will do, for each of the option, you will find the EPS, and under whichever option the EPS is highest, you will go in for that particular option for raising the finance of rupees 20 lakh. Okay, so we have to calculate EPS. So how do you calculate EPS, students? you know EBIT, less interest, less tax, less preference dividend, you get earnings available to equity shareholders. Whatever is the earnings, you divide it by number of equity shares, you get your earnings per share. Okay, so we have written here option A, option B, option C, and option D. First, I just solve it for option A. So option A is entirely through ordinary shares. So we have to see this only 20 lakhs to be raised entirely by ordinary shares. We know the EBIT is 8 lakh rupees. Less interest. Your interest is going to be zero. Why? Because entirely if you are raising the finance through equity shares, there is no question of interest. There is no debenture in this option. So when debenture is not in the option only, therefore interest will to the debenture holders will be nil. So 8 lakh minus 0 will be 8 lakh. Less tax. Tax will be there. So student, irrespective of any type of option, any type of capital structure, tax will come into picture. So tax is already given in the problem as 50%. So less tax at 50%, that is 8 lakh into 50%, 4 lakh. So earnings after tax is 4 lakh. Less preference dividend. Now in option A, will preference dividend come into picture? No, because 20 lakhs is raised only through issuing equity shares. Now when preference shares is not issued at all, preference dividend will not come into picture. Therefore it is 0. So the earnings available to equity shareholder is 4 lakh. Now how do we calculate earnings per share? That is, we have to calculate number of equity shares. Students, we know already the number of equity shares are 25,000, that is old, plus additionally you are raising 20 lakhs, okay, of rupees 100 each. So how many shares will be there? If 20 lakhs is the amount that you're going to raise and per share value is rupees 100, then what are the number of shares to be issued? It is 20,000. How did you get that? Rupees 20 lakhs divided by rupees 100. So what is the total number of equity shares under option A? It is 20,000 here and 25,000 already old, which is there. So 25,000 plus 20,000 is 45,000. And how do you calculate EPS? It is 4 lakh divided by 45,000, that you got it as 8.88 rupees is the EPS for option A. This format to calculate EPS will remain the same irrespective of the capital structure. Now let us move ahead to option B. Option B has 10 lakhs equity shares and 10 lakhs debentures. So we start with EBIT, which is 8 lakh, less interest. Now since your debentures are issued, obviously interest to the debenture holders has to be written. So it is 8% per annum on 10 lakhs. So 8% per annum on 10 lakhs is 80,000 rupees. So 8 lakh minus 80,000, you got 7 lakh 20. Less tax 50%. So 7 lakh 20 into 50%, you got 3 lakh 16. So earnings after tax is 3 lakh 60. Less preference dividend. Now in this option, there is only issue of equity shares and there is only issue of debentures. So preference shares have not been issued. So obviously when it has not been issued, preference dividend will be nil. So there is no preference dividend. Therefore, earnings available to equity shareholders will be 3 lakh 60. Next, we need to find out the number of equity shares for option B. So old 25,000 is there only, plus new 10 lakh equity shares are issued. So 10 lakh equity shares are issued and per share value is rupees 100. So what will be the number of equity shares that will be issued? That is 10,000. How did you get that? 10 lakh divided by 100. So total number of equity shares for option B is 35,000. How do you calculate the EPS? 3 lakh 60 divided by 35,000, you got 10.29. Next, for option C, rupees 5 lakhs has been issued through ordinary shares and 15 lakhs through debentures. So it is same like option B, only the value is changed. Like here 10 lakh equally, here 5 lakh through equity and 15 lakh through debentures. So obviously your figures also will change. So first you have taken EBIT 8 lakh less interest. Interest you have taken on 15 lakh, you have taken 9% as interest. So you got interest to the debenture holders as 1,35,000. So you have to take 15 lakhs into 9%. You got EBIT 6,65,000. Then you have deducted tax at the rate of 50% on 6,65,000, which you have got 3,32,500. You got earnings after tax as 3,32,500. Since in option C, the finance is not raised through equity through preference shares, therefore preference shares dividend will not come into picture, therefore it is nil. Earnings available to equity shareholders is 3,32,500. Now, under option C, what are the number of equity shares? Already 25,000 earlier shares, and under option C, 5 lakh equity shares have issued. So, rupees 5 lakh divided by rupees 100. So, number of equity shares is 5,000. So, that is 25,000 plus 5,000, that is 30,000 is the total number of equity shares. So how do you calculate EPS for option C? It is earnings available to equity shareholders divided by number of equity shares. So 3,32,500 divided by 30,000, you got rupees 11.07. Now option D. Option D, they are telling rupees 10 lakh through ordinary shares and rupees 10 lakhs through preference shares with 5% dividend to the preference shareholders. So here in option D, the finance is not raised through debentures. Therefore, interest on debenture will not come into question. So it is zero. So EBT is 8 lakh less tax at 4 for 50%. So that is 4 lakh. Of earnings after tax is 4 lakh. But preference dividend will come into picture in the option number D because they are raising 10 lakhs through preference shares. Now what is the dividend? 5%. 5% dividend on 10 lakhs. So which is 50,000. So earnings available to equity shareholders is 3 lakh 50,000. Now, what are the number of equity shares? The old shares, that is 25,000, plus the number of shares that are issued for rupees 10 lakhs. So if you want to know the number of shares, it is 10 lakhs divided by 100, that is 10,000. So for option D, the number of equity shares is 25,000 plus 10,000, that is 35,000. When you divide earnings available to equity shareholders divided by number of equity shares, you get earnings per share, that is 10. Now, students, you all tell me, out of option A, B, C, and D, which option should the company select in preparing its capital structure and why? Yes, students,
Option C,
why option C?
because EPS is high.
Very good, you are correct. Can you tell me under option C, how can it raise this 20 lakh rupees by issuing what? By what combination?
5
What is
lakhs
option?
through equity shares and 15 lakhs through debt.
That is debentures. Very good. Your answer is absolutely correct. You've given the correct answer. So this is the way we solve EBIT and EPS analysis, and this analysis helps us in knowing the best financial plan to be selected, okay, which will increase the earnings or wealth to the shareholders. Next, did everyone understand the problem number 1? Yes. Yes, students. Did everyone understand problem number 1? Can we move ahead to problem number 2? Is it clear? Problem number 1, is it clear to everyone? Yes?
Yes, ma'am.
Let us move ahead to problem number 2. So all problems are on same line, students. ARC has currently, this is a question from previous year question paper 2016. ARC has currently equity capital consisting of 15,000 equity shares of 100 each. Currently they are having that. The management is planning to raise rupees 25 lakhs to finance a major program of expansion and is considering 3 alternative method of financing. So that the 3 plans, you have to help the company in knowing which plan is best. So first it is thinking to raise this 25 lakhs through issue 25,000 equity shares of rupees 100 each, or to issue 8% debentures of 100 each, or to issue 25,000 8% preference shares of rupees 100 each. The company's EBIT is 8 lakh rupees. The corporate rate of tax is 50%. Determine EPS in each alternative and comment on the result. So students, here what the problem is telling is the company wants to raise 25 lakhs. So it is having three options. Either raise the complete 25 lakhs through equity shares. Option B, raise the complete 25 lakhs through issuing debentures. Or option C, raise the complete 25 lakhs by issuing the preference shares. So what we will do, how will we help them? We will do the EBIT and EPS analysis. For that, we have to start with EBIT and end with EPS. Wherever the EPS is highest, we are going to recommend the company to select that particular option for raising its finance. So calculation of earnings per share. Now under option A, before we start, I just want to know from you all, under option A, will interest to debenture holder and preference dividend come into picture? Yes, students? Under option A, will interest to debenture holders and preference dividend come, or will it be zero? Yes, students? Students? Suppose that the company is opting for the first option. Will it have to pay interest to the debenture holders? Will it have to pay the preference dividend under first option?
No,
Yes.
ma'am.
Yes. What did you say?
No, ma'am.
Very good. Under second option, has does it have to pay the interest to the debenture holders and preference dividend, or either of one it has to pay? Yes. What is the situation in option B? Does it have to pay interest to the debenture holders? Yes or no?
Yes, ma'am.
Yes. Okay. In the third option, does it have to pay dividend to the preference shareholders?
Yes, ma'am.
Okay. So when you're not solving, be very careful in knowing this, that yes, in this particular option interest is to be eliminated, or in a particular option preference dividend is to be eliminated. Okay, so now we start solving particulars option A, B and C. We start with EBIT, which remains the same for all the companies, for all the options, 8 lakh rupees for each of the option, less interest. For option A, there is no interest. Why? Because the entire 25 lakhs is raised through equity shares. For option B, yes, there is going to be an interest because the entirely it is raised through debentures and interest is of 8%. So 25,000 into 100 is the total value of debentures, that is 25 lakhs. Into 8% you get is 2 lakh rupees. So what you have to do, 25,000 debentures into rupees 100 per debentures, you get 25 lakhs as the value of debentures. On that you have to take 8%, you got 2 lakh as your interest. In option C, interest to debenture holders will not come into picture because the entirely it is raised through preference shares. Therefore, it is zero. So EBT is 8 lakh, 6 lakh, and 8 lakh. Less in tax at 50%, which will come for all the three options. That is 4 lakh, 3 lakh, and 4 lakh. You got earnings after tax 4 lakh, 3 lakh, and 4 lakh. Less preference dividend. Now, under option A, it is completely through equity, therefore, preference dividend will not come into picture. In option B, it is completely through debentures, therefore, preference dividend will not come into picture. Under option C, preference dividend will come into picture, that is 25 lakhs, 25,000 preference shares into 100, that is 25 lakhs into 8%, you get the preference dividend as 2 lakh. Therefore, under option A and B, you have written it as nil, and under option C, you have written 2 lakh. So what is the earnings available to equity shares shareholders? It is 4 lakh. 3 lakh and 2 lakh. Number of equity shares. Now for option A, already the old number of equity shares are 15,000 plus under option A 25,000 are being issued. So 25,000 plus 15,000, that is 40,000 is the number of equity shares in option A. Under option B, it is completely raised through debentures. So only the old equity shares will come into picture, that is 15,000. And under option C also, completely it is raised through preference shares. Therefore, equity shares will be 0 and only the old equity shares will come into picture, that is 15,000. How did we calculate EPS? 4 lakh divided by 40,000. For option B, 3 lakh divided by 15,000. For option C, 2 lakh divided by 15,000. We got rupees 10, rupees 20, rupees 13.33. Can you all tell me which financial plan or which capital structure should the company opt for? Yes. Which option should the
Option
company
B,
opt? Why? Why option B and under
because it
option
has
B?
highest EPS.
Okay, and what is the structure? What is going to be the financial structure under option B? How it is going to raise 25 lakhs?
Through debentures.
Only through debentures. So very good, students. Now let us move ahead to problem number 3. This had come from the previous year question paper 2018. Yadu company has a capital of 1 lakh that is divided into shares of rupees 10 each. Okay. It has expansion plans requiring an investment of another 50,000. The management is considering the following alternative for raising the amount. So already it has a capital of rupees 1 lakh. Okay. Now it wants additional 50,000 and it is considering these 3 options. Okay, option number 1, issue of 5,000 shares of 10 each. When nothing is mentioned, that means it is equity shares, students. Issue of 5,000 shares of 10 each means it is equity shares. Issue of 5,000 12% preference shares of 10 each. Issue of debentures of rupees 50,000. So three option is one option A is entirely through equity. Option B is entirely through preference shares and option C is entirely through debentures. The company's present earnings before interest and tax is 40,000 per annum subject to a tax of 50%. Okay. You are required to calculate the effect on each of the above modes of financing on the EPS presuming EBIT continues to be same even after expansion and EBIT increases by rupees 10,000 after the expansion. So here we have to see when the EBIT remaining the same, even when you're expanding it, the earnings is remaining the same. Second, when you're expanding it, your earnings also is increasing by 10,000. So in both the situations, we have to find out which is the best financial mix. Okay. So let us start calculation of earnings per share for present and proposed plan. For the first one, we are going to when the EBIT is remaining the same even after expansion. That EBIT is 40,000, and even after expanding, like the expansion plan also, the earnings before interest and tax is remaining 40,000. So see students here. EBIT, this is a present structure, this is a proposed structure. Proposed structure, you have A, B, C option. EBIT is remaining the same, that is 40,000 under each of the options. Less interest. Now students, interest to the debenture holders will come only under option C. Why? Because under option C only they are going to raise 50,000 by issuing debentures. Now, here we have taken 5,000 as the value. Next, EBT is 40,000 same, less tax at the rate of 50%. So 40,000 into 50%, 40,000 into 50%, and likewise, you got earnings after tax as 20,000, 20,000, 20,000, and 17,500. Less preference dividend. Now, can you all tell me under which option will preference dividend come into picture? Yes, students?
Option B.
Option B. So option B, you have considered uh, Preference dividend, that is 50,000 into 12%, you got 6,000. So you got earnings available to equity shareholders. Okay. After that, you have to take number of equity shares. Now for the present structure, students, what is the number of equity shares? Present, that is current structure, they have rupees 10 lakhs. Okay, divided into shares of rupees 10 each. So can you all tell me what are the number of shares here? In the present structure, what were the number of shares? If they have taken 1 lakh rupees as capital by issuing shares of rupees 10 each, what is the number of shares that they have issued? Yes.
10,000.
Okay. So 10,000 for present structure, it is 10,000. Okay. For option A, it is going to be the present structure, that is 10,000 plus your 5,000. So total it will be 15,000. For option B, it is completely through preference shares. So your equity shares will not come into picture, but the current present shares of 10,000 equity shares will come into picture. The option C also, it is issued completely through debentures. Therefore, only the present 10,000 will come into picture. Therefore, first, for present structure, it is 10,000. For option A, it is 10,000 plus 5,000. Option B, again 10,000. Option C, again 10,000. Since it is completely, option B and C are completely raised through issuing preference and debentures, therefore, number of equity shares will not come into picture. So 10,000, 15,000, 10,000 and 10,000 respectively for option A, B and C. Earnings per share is nothing but earnings available to equity shareholders divided by number of equity shares. So you got rupees 2, rupees 1.33, rupees 1.40, rupees 1.75. So this is when EBIT continues to be same even after expansion. Next is year. So, okay, here they have also shown dilution in against present EPS. See students, their present EPS was 2. Present means without raising that additional 50,000, their present EPS was 2. Now, the present EPS is 2, and after raising additional 50,000, their EPS is decreased. So when you compare it to the present, what is the reduction in the EPS? That is nothing but dilution against present EPS. So when the present was rupees 2 and later after expanding 50,000 rupees, by raising 50,000 rupees, their EPS has come down to 1.33. So what is the dilution in this? How much EPS has gone down? It has gone down by 0.67. Similarly, here 1.40 and here it was 2. So how much the EPS has reduced from its present value by 0.60. Similarly, with option C, the EPS has reduced from 2. Present EPS was 2 and it has reduced after expansion of 50,000 to 1.75. So what is the dilution in EPS? It is 0.25. So students, which option will you select? Out of these three, see students, your present EPS was 2, but option A, B, C has reduced your EPS to its present EPS, current EPS. So which particular EPS will you select? Which particular option will you select where the EPS dilution is minimum? So can you all tell me, out of option A, B, C, which option will you select? Yes, students? Yes. Which option will you select among these three options? Yes, students. Which option will you select? 1.33, 1.40, 1.75. Yes, students. Present structure for credit. Proposed structure. Which option will you select? Option A, B, or C? Yes. Yes, students. You'll obviously select option C, right? Because the EPS is at maximum 1.75 and the dilution also is less. Dilution means compared to the present value, a present EPS, the the reduction in the EPS is less when compared to option C. Here it has reduced drastically 0.67, 0.60, but here it is reduced little minimum when compared to option A and B, that is 0.25. And when you compare EPS, you will select from option A, B and C, you will select option C because it is giving you the highest EPS when compared to these three options. So in the above table, lowest dilution is in option C. Option C is issue of debentures, therefore you will opt for it. Have you understood this A part, first part, students? Yes? Yes, students? Have you all understood it?
Yes, ma'am.
Okay. Now what they're telling, EBIT increases by rupees 10,000 after expansion. So what you have to do, present structure will be 40,000. But after expansion, their EBIT is increasing by 10,000. See here students, when EBIT is increasing by 10,000, you have to add 10,000 to 40,000. That is 50,000 will be your EBIT for option A and B and C. So EBIT increases by 10,000 after the expansion, after the expansion. So when EBIT is rupees 50,000, present structure will remain the same. There will be no change in the present structure. Now our entire calculation will be same what we have solved previously here, but only your EBIT is changing to 50,000. Rest entire calculation will be same. Now, can you all tell me out of option A, B and C, which one should be selected and why? Yes, students?
Option C because it has highest EPS.
Very good. Option C has highest EPS and it is increased positively. Present structure was rupees 2 and with option C, the after expansion the EPS has increased to 2.25. Therefore, you have to go for option C because EPS is highest. Okay, very good. Is problem was problem number 3 clear to everyone? Yes, students? Yes? Yes, students, is it clear?
Yes, ma'am.
Now let us move ahead to problem number 4. The capital structure of a company consists of equity share capital of rupees 10 lakhs, okay, and rupees 10 lakhs of 10% debentures, okay. Sales increased by 20% one from 1 lakh units to 1 lakh 20,000 units. The selling price is rupees 10 per unit. Variable cost amounts to rupees 6 per unit and fixed expenses amount to rupees 2 lakh rupees. Income tax is assumed to be at the rate of 35%. You are required to calculate the percentage increase in EPS, the degree of financial leverage at 1 lakh units and 1 lakh 20,000 units, the degree of operating leverage at 1 lakh units and 1 lakh 20,000 units. Comment on the behavior of operating and financial leverage in relation to increase in the production from 1 lakh to 1 lakh 20,000 units. So students, this particular problem is a combination of, EPS, EBIT and EPS as well as leverages, which we have done in our previous lecture. So we know that when we solve leverages, okay, we have to start with sales less variable cost, we get contribution, less fixed cost, we get EBIT. Okay, so we have to start with sales. Here what they are telling is you have to consider sales at 1 lakh as well as 1 lakh 20,000 units. Okay, so let us start calculating. So calculation of earnings per share, and from sales you end up with, once you get EBIT you will easily get the earnings per share. Okay, so for 1 lakh units we do first, and on the same lines we do for 1 lakh 20,000 units. Okay, so we first start with the sales revenue. Sale revenue, here the selling price is directly given 10 per unit. So students, if it is 10 per unit and there is if 1 lakh units, it will be 10 lakh rupees. I will show you for 1 lakh units. Similar, you have to solve for 1 lakh 20,000 units. That is 1 lakh 20,000 units into 10, you get 12 lakhs. Less variable cost. Variable cost is directly given in the problem 6 per unit. So 6 into 1 lakh, you get 6 lakh. From sales price, when you minus variable cost, you get the contribution, that is 4 lakhs. From 4 lakh, you deduct the fixed cost. Fixed cost is given in the problem directly that the fixed expenses are 2 lakh rupees. You get EBIT. EBIT is 2 lakh. Now, once you got EBIT, you have to less interest. Interest is here, students. See, 10 lakhs of rupees, 10% debentures. So, what is the interest? 10% into 10 lakh rupees, that is interest is 1 lakh. So EBT, you got it as 1 lakh. Less tax is already given in the problem, 35% of 1 lakh, that is 35,000. You got earnings after tax as 65,000. Less preference dividend. Students, in this particular capital structure, it is raised only through equity and debentures. Therefore, preference dividend will not come into picture. You got earnings available to equity shareholders as 65,000. Now, number of equity shares is given, that is 10 lakh divided by 100. You got 10,000 as your number of equity shares. So, your earnings per share will be 65,000 divided by 100. That is 6.5 is your earnings per share. On the same lines, students, on this same lines, you do it for 1,20,000 units. No change at all. Okay. Then first they are asking you the percentage increase in EPS. So if you want to know the percentage increase in EPS from 1 lakh units to 1,20,000 units, you have to first take the change in EPS, okay, divided by the EPS at 1 lakh rupees into 100. With this, you will understand what is the percentage increase in EPS. See, increase in EPS in rupees you can find out, that is 11.7 minus 6.5. So in rupees, the EPS is increased by 5.2. But if you want to know the percentage increase in EPS, you have to know the change in EPS. Change in EPS is 5.2 divided by EPS at 1 lakh units, that is the at 1 lakh units, that is going to be your base into 100. So it is going to be 5.2 divided by 6.5 into 100. So the percentage change in EPS is nothing but 80%. So by 80, suppose when your sales volume is increasing from 1 lakh unit to 1,20,000 units, your EPS also is increasing by 80%. So if your sales volume is increasing, your EPS is also increasing by 80%. Your second question was the degree of financial leverage at 1 lakh units and 1,20,000 units. So financial leverage, as we know, is nothing but EBT divided by EBIT. So at 1 lakh units, the EBIT is 2 lakhs and EBT is 1 lakh. So you got 2 times. And similarly, at 1,20,000 units, you should know the formula, students. It is EBIT divided by EBT. So at 1,20,000 units, the EBIT is 2 lakh 80 divided by EBT is 1 lakh 80. So 2 lakh 80 divided by 1 lakh 80, you got 1.56 times. The third question that they are asking you is the degree of operating leverage at both the units. So operating leverage is nothing but contribution divided by EBIT. So at 1 lakh units, you pick up the contribution from the format divided by EBIT, you got 2 times. And similarly, at 1,20,000 units, take the contribution 4 lakh 80 divided by EBIT 2 lakh 80, you got 1.71 times as your operating leverage at 1,20,000 units. So what has happened here, students? EPS has gone, as I already told you this, students, EPS has gone up by 80% as a result of increase in production from 1 lakh to 1,20,000 units. Financial and operating leverage have gone down. See here, 1 lakh units, it was 2 times. At 1,20,000 units, it is 1.56 times. So it has gone down. Similarly, for operating leverage also, it for 1 lakh unit, it was 2 times. And for 1,20,000 units, it is 1.71 times. So both financial and operating leverages have gone down. Thus, the risk of the company is also minimized. Is this clear, students? Is problem number 4 clear to everyone? Yes, students? Was a combination of where you had to find EPS as well as leverages. But this format, students, from the sales revenue up to EPS, this format will remain same irrespective of level of units, okay, or irrespective of any financial plan. Is this clear?
Yes, ma'am.
Yes, student? Okay. This is the last problem, number 5. Okay. The selected financial data for ABC companies for the current year 31st March are as follows. Okay, ABC. Variable expenses as a percentage of sales. We know variable expenses is as a percentage of sales, which is given 66.67% and 75% for B and 50% for C. Interest expenses, student. Interest expenses is that debenture expense to the debenture holders, that is financial cost, 200, 300,000. Operating leverage is given 5:1, 6:1, 2:1. Financial leverage is given 3:1 for A, 4:1 for B, and 2:1 for C. So this is nothing but 5 times, 6 times, 2 times, 3 times, 4 times, and 2 times. Income tax is given as 35%. Okay, 35% and 35% for A, B, and C. Prepare an income statement for A, B, and C companies. Okay, students. So what we will do is, now it's already 11. We will take this particular problem in the next class because at least 15 minutes or minimum 10 minutes are required to explain this particular problem. Is it clear? Yes, students, this is the last sum, after which we will be completing with module number 6. So we continue this particular problem in the next class. Thank you so much, students. We are done for the session for today. Thank you.